Can I use IUL for other things than just for my retirement? Welcome, this is episode 16 of our Secrets to Tax-Free Growth series. Last episode we went through comparing IUL to other vehicles. Now what we're going to tackle, what we mentioned in the last video, is can this be used for other things? The answer is absolutely. It is like a financial Swiss Army knife, as one of my mentors said. It can be used for so many different things. What you have to keep in mind is the 5 key things we went over last video, which is that the IUL's strength are the tax-free growth, the tax-free access, the tax-free transfer, so if you die it's going to blossom and transfer tax-free, the protection from the market downturns, and the market-like returns. So instead of asking the question for each individual item of can the IUL be used for this, look at those 5 benefits and think what can it be used for. That's what we're going to do in this video. The only thing I want to give a quick warning is, even though the IUL can do a lot of things, typically you're not going to be able to focus on all of these things. So yes, you might be able to use it for retirement, and if you do need to change and say, hey, you know what, I have enough retirement income over here from something else, but I want to access that money to go fund a business, you can do that. But if that's the case, well, it's no longer going to perform as well for retirement if you took out a larger lump sum earlier on. So one big mistake, even when the policy is structured properly and funded maximally, what people will do is try to use the IUL for so many things. Estate planning. For when I pass away, I want my money to blossom and transfer tax-free, so I leave behind a bunch of money to my heirs. Well, if you do that, that's fine, but you're going to have a much higher death benefit. You're not going to be max funding. You're not going to get as much income. Maybe if you access the money too early, the policy might get close to lapsing. You'd have to put more money in. So the main thing is that you must be very intentional with how you plan to use the IUL and stick to that. The good news is there's flexibility if you want to change, but just keep in mind, we're not trying to attack 4 or 5 goals at once. So a lot of people say, hey, you know, your life insurance is supposed to be used while you're alive, right? Well, don't use it for the life insurance and for the cash value side of things. I have my own IUL that I put money into, and as that grows, I'll be able to access that to use for my business, different ventures, whatever it might be. And then I also have a term policy that is separate for that, for just replacing my income if I were to pass away. Now, a really easy way to be able to look at if IUL can do something, at least as a starting point, is viewing it like your own bank, but it has a higher rate of return. Of course, you have all the tax benefits and it can't lose, but just viewing it like that to begin with. So starting with a working capital account for a business owner, someone who wants to grow money, they don't know when they're gonna need to access it, which this is something that a lot of business owners get killed by. I don't want to put my money in some sort of investment or some sort of vehicle because, you know, some opportunity might come up and I might need that money, so I'm just going to keep it in a bank and it's not necessarily going to earn an optimal rate of return, but at least it's liquid. Well, in this case, you would be able to have that money, have the cash value grow, and let's say you're someone who flips apartment complexes, for example, and when a deal comes up, you might need $1 million within 24 to 48 hours. Well, just like a bank, instead of keeping that money there, of course you wouldn't be FDIC insured unless you had it across a bunch of different banks because that's only $250,000. But if you needed that money, it'd be as simple as, I need the $1 million. Whether it's a phone call or a form, you're able to fill that out, get the money transferred to you right away, and use that for buying the apartment complex. So just as a bank account or a business bank account would be able to be used as a working capital account, same deal with the IUL, but what's the difference here? Of course the rate of return, of course the tax advantages, but when you pull out that $1 million, let's say you put it into the building and you are going to keep it there for a full year. Well, if you did a variable loan and you take that, let's say it capped at 5% again, that's what the loan rate is. Well, if the index gains 10% that year, well, even though you took the $1 million out, and yes, it was accruing a 5% interest, so there was $50,000 extra in interest, the index also gains 10%, so you gained $100,000. So in that case, you made $50,000 on the $1 million that you took out and put into the apartment building. So does that sound like a better working capital account than a bank? Of course. It's a similar deal with real estate management, for example. The value of a home is going to change whether or not your money is in the home. A lot of real estate investors know this. The problem is they don't want to be over leveraged because, of course, you know the banks can snap and they want all the money paid off. But they're much more comfortable doing this if the money is safe and liquid over here in an IUL, for example. So the home is still going to gain its value, but the money is over here in an IUL. So if that were to happen, God forbid, you have leverage with liquidity. So leverage without liquidity is stupidity. So when something happens, they need that money, you're able to pull the money out of the IUL, give them the money, and that whole time you are able to not only gain money on the appreciation of the houses, but the money was also over here in the IUL, safe, liquid, earning a rate of return. And now that you pulled it out to go and pay those things off, depending on which loan rate you took, and this is going to vary person to person, but if you took a variable, now that money's earning you a spread even though it's back into the houses. So huge for that. Obviously, anything where you're going to grow money to use later, it's naturally going to be used for. So that's your college planning, your retirement planning, anything like that. You're putting money away, you're letting it grow, you're using it later. Obviously going to be able to be used for that. Look at like a 529 plan, for example. Of course, if you put that money in, it grows tax-free. But what if your kid doesn't want to go to college? What if he wants to start a business? What if he gets a scholarship? Well, then you're not going to be able to use it for that. You might have to pay taxes or take penalties. In this case, you're able to do the same thing, but you have much more flexibility. You can change the beneficiary. They can go to school out of state, depending on what kind of 529 plan you pick. So in this case, the vast majority of the time, it's going to be a no-brainer. Think about pension maximization, for example. Think of the 5 keys again. Grows tax-free, access tax-free, transfer tax-free, still have the downside protection, and you get the market-like returns. Of course, that's going to be something you can use it for. Estate planning. All of this money, like we mentioned, transfers tax-free. So when you do die, not only is the money that you're going to have in there going to transfer tax-free, but it's going to blossom and grow into a bigger number. Now, especially in the early years, if you die early on, the rate of return that you're going to get is going to be massive. So let's say you were putting $200,000 in a year, putting in $1 million over 5 years, so $200,000 for the first 5 years. Well, if you die right after you put the first premium in, well, if your death benefit, for example, was $2.5 million, your heirs get the $2.5 million, and you didn't even fund the rest of the $800,000. Now they get $2.5 million tax-free, plus your $800,000 that hasn't gone in yet. That goes to them just in your regular estate plan, and everyone's happy. The last thing that I'll say is the emergency fund. A lot of people start to put money into an IUL and then get the thought of, all right, well now I got to start to rebuild up my emergency fund because I just put some money in there from my savings. Well, that's not the point. The IUL can be used for an emergency fund. Now, does it generally take 24 to 48 hours to get the money? Yes, so of course you want to keep a small amount of money for small emergencies in a bank, but for those bigger emergencies, medical bills, things like that, within 24 to 48 hours, anything that you're going to have that little time delay to be able to get, that of course you can use the IUL for, pull the money out when you need it, spend it, and even though you did that, now you're still going to earn a spread on that money that you pulled out. So that was a lot. That's why we call it the financial Swiss Army knife. It can be used for so many different things. Next video, we're going to go over, what if I'm uninsurable? What if I'm not healthy? Don't count yourself out. This is something we talked about at the very beginning of the series. There was 5 parties to every insurance contract. The owner does not need to be the insured. We'll go into that in a little more detail next video. I will see you there.